With an AI bubble inflating, a new Fed chair coming, and the US-China relationship in an uneasy truce, certainty is in short supply. In The World in 2026, Capital Economics highlights the key risks and opportunities in the year ahead. These written reports, virtual briefings, and in-person meetings give decision-makers critical insight for what's bound to be another challenging year in global macro and markets. Check out The World in 2026 at capitaleconomics.com today.
Welcome to The Weekly Briefing, a podcast from Capital Economics. I'm David Wilder, and this is a special episode all about the European outlook. And to find out about that, I'm joined by Group Chief Economist Neil Shearing, but also by special guest, Chief Europe Economist Andrew Kenningham. Hi, Neil. Hi, Andrew.
Hi, David.
We had our World in 2026 client event in London earlier this week, and it was looking at the big opportunities and risks in global macro in the coming year. What I found striking was just how little Europe featured in our conversation with clients. And I guess on the one hand, that's encouraging in as much as we're not expecting anything disastrous on the European growth front in 2026. But it does stand out because of the enormous optimism around Europe just a few months ago. So back in May, in that same room where we were briefing clients earlier this week about 26, we were tackling this question about this groundswell of optimism around Europe, that somehow the narrative had changed around Europe. And at the time, we didn't really buy into it. But more generally, it does feel like anyone who had bought into it then has since lost a bit of faith. Andrew, let me ask, what happened to all that optimism around Europe?
Yeah, you're absolutely right, David. The optimism has rather fizzled. But if you think back to where we were in the spring, I think you had two things coinciding. One was the optimism about Europe, which was around the fiscal reforms in Germany and the election changes there and the increase in defense spending. But then the other side of it was there was the sell America trade and the worries about what was going on with US macro policy. So I think both of those things are relevant, and they've both reverted to their more normal states, if you like. So there's been a recovery in confidence in the US. The worst fears around Liberation Day have passed. But on the European side, as we had thought, the fiscal stimulus is going to be very slow. It's taking a lot of time, and the benefits from it are going to be weak. We've seen the German government get bogged down in coalition discussions and ending up funding increased pension expenditure rather than putting money into sort of infrastructure spending that might have boosted growth more. And meanwhile, France's public debt problems have continued to worsen. So it's really a reversion to the kind of status quo ante, if you like.
So we've gone from Euro optimism back to the center, but not necessarily Euro pessimism. I mean, has anything fundamentally changed? You talk there about the shift in German fiscal policy. I mean, there has been some kind of fundamental change there, hasn't there?
Well, there has been a change. I would characterize it mainly as that they have removed this constraint, which was this extremely tight debt rule, which was creating massive problems for the previous three-party coalition because there was just no money to spend, even on the areas where they'd already committed spending. So Friedrich Merz made this very bold move immediately after being elected and got that debt brake removed, and it's kind of allowed them to continue doing what they were previously doing and not to tighten policy more than really than they would have liked to. But if you look at the numbers, the fiscal deficit in Germany was 2.7% of GDP last year. This year, it's going to be around 2%. So it's going to be smaller. And even next year, we think it will increase only to around 2.5%. So it'll still be a bit smaller next year on our forecast than it was in 2024 before the election. So yes, they've avoided a big contraction or a big sort of fiscal squeeze, but they haven't really yet dedicated themselves to a big fiscal splurge, if you like. By 27, maybe there'll be a little bit more. So yeah, there's been a change, but it's not as dramatic as one might have hoped.
So when we talk about 26, we made this case for US outperformance. We've had this long-standing bearish China view. And we don't really see that shifting much in 26. So what does 2026 look like for Europe?
It really looks like more of the same. The economy has been growing, which is, better than it might have been. And Germany hasn't been growing for the last 5 years, but the Eurozone as a whole has been growing. I think we'll have another perhaps 0.8% GDP growth next year, 0.2 per quarter. So underwhelming growth. Inflation is already effectively back at the target. We think next year it'll drop below the target, partly because of headline issues around energy and food, but also the core rate's probably going to come down a bit. So we've got a forecast that the ECB will end up cutting interest rates a little bit further. They're at 2% now. We've got them at 1.5% at the end of next year. That's not a consensus view, but I wouldn't say this is a sort of radically out there forecast either. We think the problems in France will continue to build, but will probably not really spill over into a major crisis. The southern economies continue to do relatively well. So there's a lot of interest in Europe, partly in the sort of differences between different countries, but the overall picture probably fairly stable.
You said no major crisis in France on the fiscal front. Neil, let me ask you, I mean, we've been tracking fiscal risks across developed markets. When we're trying to identify where the next debt crisis will occur, what's the likelihood that it happens in Europe?
Well, past form would suggest that there's a pretty good likelihood, wouldn't it? Insofar as that was the epicenter of the last sovereign debt crisis that we had kind of 10, 15 years or so ago. When we look across the piece, there's really 4 countries that stand out amongst the major advanced economies as having public finances that look particularly unsustainable or perhaps shaky. The US, obviously, large deficit, 6.5% of GDP, debt over 100% of GDP, but benefiting from the dollar. The UK, where actually the deficit's on course to fall, the budget deficit's on course to fall over the course of this parliament, thanks to the fiscal tightening that was announced by the Chancellor a couple of weeks ago. But debt ratios are high, and of course the markets have long-standing jitters about UK fiscal policy. And then that brings us to Europe, where there are 2 countries that really stand out. Italy, where the deficit's relatively small, but in fact there's a small primary budget surplus, but the debt burden is high and growth is relatively low. And France, which Andrew has mentioned. And really, I suspect if problems do emerge in Europe, it will be in France. But the key point, I think, is whether or not that escalates into a kind of systemic fiscal crisis, both within France and then across the Eurozone. And I think that's where things are a little bit different today than they were 10, 15 years ago. Even French banks don't hold a large amount of their assets in French government bonds, which is obviously a big difference from the likes of Greece and Spain and Portugal in the mid-2010s, which created that doom loop between the fiscal position and the banks and then back to the fiscal position. So I suspect if problems do emerge on the fiscal front, then France would be a leading candidate. But as Andrew's just said, it's not in our base case. And even if it were to emerge, then that doom loop between the fiscal position and the banks is perhaps less strong, as was the case a decade or so ago. And I think the other point, of course, is that the ECB has a number of tools that it can do to stem the contagion into the rest of the Eurozone.
Andrew, let me ask you this then, given what Neil's just said. I know whenever we talk about the future of Europe, you are fond of bringing up that Jean Monnet quote. Is it that Europe will be forged in crisis?
Correct. Very well remembered.
Thank you very much. But there's a point here, isn't there, around Europe's unfulfilled potential, this sense that Europe is stuck in a rut. And I guess the question is, how does it get out of that rut? How do we stop talking about Europe in these terms?
Yeah, I think that partly it's a question of just people's perception. There's always a sense of frustration that Europe is not the United States, or perhaps even these days that Europe is not China in terms of its economic dynamism. But it isn't either of those economies, and it isn't going to be. So this kind of comparison can become a little bit absurd. But in theory, they could do all the things that Mario Draghi has recommended and many others before him. So, fiscal consolidation, much more spending on investment, capital markets union, banking union, and so on and so forth. But there's a reason why they don't do those things, which is that this is a sort of federation of national sort of sovereign countries who don't really want to pool their sovereignty and to do all those things in a unified way. Never mind all the other cultural and institutional things which mean that Europe is less dynamic than the United States. And I think it will be for the foreseeable future. In terms of concrete actions and policy, I really don't think there will be very much to see in the next few years. There is a long list of desirable things, and there's a lot of talk from the Commission. But on banking union, for example, I think we will see some consolidation. We've seen some mergers within individual countries. We've seen one or two cross-border mergers, but there's no appetite really for creating a genuine single market for banking. And on capital markets union, there's potential for joint regulation. Suggestion now there might be a new institution in France that would regulate securities markets across Europe, but there's not any appetite to harmonize regulatory rules around securities markets in all those countries. So, never mind fiscal union. I mean, there's clearly absolutely no appetite for a lot more joint borrowing. It was revolutionary that they did some joint borrowing during COVID, but the scale was very small, and it, reveals that there isn't really that desire to move in that direction. There certainly isn't with the current government in Germany, and I don't think the next French government is going to be likely to push forward on that front either. It may be a bit dull, but I don't think there's going to be massive reform in the coming years.
You mentioned Mario Draghi, you mentioned his report. He's made no secret of his frustration at just how little has happened since he published that competition report in 2024. For all that you said, I mean, isn't there more urgency now than ever, because Europe's industrial shortcomings, in the very least, they're increasingly being framed within a context of this landscape of hyper-competitive US firms, hyper-competitive Chinese firms. How does Europe fit into this global landscape where you do have such intense competition?
Well, I think Europe's position hasn't changed that much in terms of innovation since the dot-com era. So if you think back to that time, all the really big new tech firms, again, came from Silicon Valley and have spread across the world and are used by Europe, but were not invented in Europe. There are some exceptions, some well-known exceptions that were originally invented in Europe, but even they had largely got bought up by US-based multinationals. So that model is still the same. Europe will not be a source of a lot of innovation, but that doesn't mean to say it won't adopt and use the new technologies that are coming through. So we did a piece of work recently showing that Europe is way, way behind on innovation and only behind on adoption. So that's the big picture as to where it fits in. No surprise there, I would say. The other thing that's perhaps changed is that if you look back to the pre-pandemic period, the more traditional legacy manufacturing and industrial sectors were doing pretty well, at least in Germany, but they are now under a lot of pressure. And I think they'll continue to be under pressure in the coming years. And that will cause Europe's economy to grow very slowly. But the policymakers' response, I think, will be to defend and try and cushion those sectors from decline rather than to move radically towards genuinely being able to compete with the US or China in its slightly different world on the tech side.
How does Europe fend off the competition from Chinese goods imports into Europe?
I think that Europe has always taken a slightly sort of pragmatic approach to defending itself, where it sees the competition from abroad as being a threat to its individual industries, and where there's a political concern. And they've always defended their steel and aluminium sectors, for example, very willing to put up anti-dumping duties, even when the sort of technical, legal, and economic case for them is not that strong. And they will apply the same principles with imports from China where they're a significant threat to them on the economic side. And the obvious example is electric vehicles, where they have recently put up pretty substantial tariffs, which are designed not to keep out Chinese EVs completely, as the US is doing, but to limit the pace at which their market share would grow, to defend the space for indigenous European auto producers. They may well do more of that, and they may extend that to other sectors. They also obviously get caught up in some of the crossfires of the conflict over semiconductors. A couple of big incidents recently with ASML and Nexperia in the Netherlands. But that's a slightly different issue, more driven by security concerns than by economic concerns. But yeah, I think Europe's going to have a defensive posture, really. At the same time, they're going to try to continue to work with China in various areas. So Chinese companies are still free to and are investing in Europe. In EV batteries, they'll increasingly be making electric vehicles in Europe as well under the current bans. And then there's an interesting example recently, Volkswagen doubling down on its investments in China and planning to work with Chinese partners on developing EVs in China for China. And now I'm sure trying to sort of bring back that technological know-how to Europe in a kind of role reversal from where they were 20 years ago. So it's a somewhat mixed picture. There's not a very strong and clear single direction of travel. There's a lot of responsiveness to political pressures at national level. And yeah, I don't think this will help them move forward on productivity because they're going to try and defend their existing sectors and sort of manage the decline, if you like, rather than go for a big bang structural reform. But that is very much the European way of doing things.
Neil, is managed decline a viable strategy in a fracturing global economy?
Well, I think when we think about Europe specifically, there's sometimes a tendency to enter this council of despair. Yes, growth is low. Yes, innovation is pretty weak. Yes, Europe is not really pushing the global technological frontier in the same way that the US is, and indeed China now is. But this is still fundamentally relatively rich part of the world, a collection of rich economies, institutions pretty strong. And I think we've gone from a position where the macro outlook has gone from being very fragile to one that's relatively stable. There's some of those fiscal concerns notwithstanding. The economic architecture, the policy architecture has been strengthened through those crises. As Andrew said, kind of Europe forged in crises. One of the consequences of the past decade or so is that the policy architecture has been strengthened. So I'd caution against entering this council of despair, even if we're not going to have Europe going to the races on the growth front. But then you get to the question of this global economic fracturing, US-China fracturing, and how does Europe fit into that? One consequence of Europe moving relatively slowly, governing by consensus, these are all laudable qualities, but it doesn't make a global economic superpower. So I think the idea that Europe might emerge as, let's say, a third block in this fractured world around which other liberal democracies might coalesce, I don't think that's likely to materialize. Instead, really, Europe's going to have to decide whether it aligns more closely with the US or it aligns more closely with China in the areas in which the US and China pursue some decoupling. And I think for the most part, the die is cast and Europe was going to align with the US. But getting back to what Andrew was saying and how Europe responds to some of the challenges from China, I mean, the way I've been thinking about this is that there's really two aspects. There's the pure economic competition from China, and that is undoubtedly intensifying. I mean, it's striking that after Europe put those quite substantial tariffs on imports of Chinese electric vehicles, the price of those vehicles at the factory gate in China has fallen by about 10%. So the pace of price declines, price deflation in China and increased competition, therefore, for the rest of the world is enormous. And I think sometimes Europe struggles to catch up with that on the economic competition front. But then the second part is economic security and national security. And this is something that economists have never really had to think about for the past 40 years or so. So it doesn't really enter into our models. Now, one way of thinking about this would be if China wants to subsidize its domestic industrial producers to the tune of 5% of its GDP each year, and therefore produce intense price competition, that's great for the consumers in the rest of the world. The rest of the world should accept that, and that's a cost borne by China in terms of those subsidies. But that negates or neglects the interaction with economic security. What is the wisdom of having large amounts of Chinese technology within our ecosystem in Europe? And that's a debate that there are pros and there are cons, but it's a debate that is not really happening to the same extent in Europe as is in the case in the US, for example.
Is that because it's Europe internally is so fragmented? Andrew, I actually did want to ask you, you've made it clear that we don't expect sort of capital markets union, this greater integration within the Europe project. Talk a bit about expansion. Are we going to see more countries joining Europe? And does this mean an even more fragmented political makeup? Or do we see any push towards greater union?
So the expansion of the Eurozone, is continuing, but it's very small beer. We had Croatia join a couple of years ago. Bulgaria, has been in a currency board, so it's effectively been shadowing the euro very closely for a long time. Won't make a big difference to Bulgaria to join the Eurozone. It will make no difference to the rest of the Eurozone. Enlargement is a sort of to the EU as a whole is another issue. And I think progress on that front is likely to be pretty slow, given the political shift towards the right and towards more skepticism about migration and about European integration in the core European countries. But there may well be some of the smaller countries in the West Balkans might join the EU within the next decade or so, perhaps. But again, those would not be something that would make a huge difference. Ukraine is the really big one, but that'll be a long, long way away if they ever join. And the same with Turkey, which is forever in the waiting room, as it were. But in terms of security issues, I think the question for Europe is to what extent they really woken up and smelt the coffee about the security situation and about the US withdrawing a lot of its support and Europe having to take on responsibility for managing the risks around Russia with Putin. It's still in the Kremlin. And, my impression is that there's a recognition of that, how big that risk is in some of the Eastern countries, Poland and obviously the Baltic republics. There has been a big shift in Germany, but the implementation of the defense spending will be slow. And in the rest of Europe, there's still really not a complete mind shift towards recognizing the scale of the spending and the change in the kind of spending and the integration and cooperation that would be needed to be able to really defend Europe effectively without US support. So there's been much less of a change than a lot of people would have liked to see, and much less, I think, than Donald Trump and co would have wanted to see. But I think that pressure will continue to be put on Europe, and their response will continue to be to drag their feet and to move quite slowly.
It does come back, doesn't it, to this question of maybe the global story, that fracturing that Niels talked about, that's generated new urgency where Europe cannot afford to continue at the speed it has. You hear some strategists, you hear some officials talking about what Europe needs to do in the face of Russian aggression and this potentially reduced US presence that you talked about. And they're basically talking about needing to build a military industrial complex and to do it quickly. But economically, it doesn't sound like, and politically, it doesn't sound like that's likely in the near term.
Yeah, so what they would ideally do, depends on how big you think the threat is, how much you think the US is going to leave. What they're actually going to do will reflect the sense among politicians and really among the public in Europe about how urgent the situation is. And going back to the crisis issue, I don't think it's the perception of enough voters is that this is really a crisis, either in terms of security or in terms of Europe's competitiveness internationally, for there to be a radical shift in policy at European level. And no surprise, I think, but that's what we'll see is a kind of slow movement in the direction that you'd like to see, but nothing radical.
And how much is, talk about this guns versus butter debate, how much constraint is there in terms of the fiscal resources necessary to meet that challenge?
Well, it's very hard. The fiscal position in nearly all major European countries is very tough. Even without the plans to increase defense spending, there are pressures from population aging, from the increase in interest rates, and from the legacy of very high debt, all the higher since the pandemic, which are forcing governments to make very difficult decisions. So we've seen the government in the UK, government in France, really struggling to push through any kind of welfare reforms or pension reforms to try and bring down expenditure. And if they're not able to do that, then they're going to really struggle to devote a lot more to defense, even if they've got political cover to do so. And even if the EU says defense spending can be exempted from some of their budget rules, they're just reluctant to move quickly because of their understanding of the market pressures in the short term.
That was Andrew Kenningham and Neil Shearing on why Euroscepticism is still justified, but also why the Council of Despair around the European economic outlook isn't. There's a whole body of work on the future of Europe that we produced earlier this year. I will link to that in the podcast notes, as well as a recent report which looks at why ECB rate cuts aren't helping to boost Eurozone growth. This coming week, we are holding our World in 2026 drop-ins. These are our short-form online briefings. There are two this Wednesday, 10th of December at 8 a.m. London, 4 p.m. Singapore, and then at 3 p.m. London, 10 a.m. New York. So do join those to hear from the team about what we think will drive macro and markets in the coming year. Later that day, 9 p.m. London, 4 p.m. New York, our North America team will be online to take questions on what could be one of the most contentious Fed meetings we've had in some time. We're expecting that meeting to end with another 25 basis point cut, but which way voting goes on the FOMC could be very telling about the path of US rates in 2026. That's our post-December Fed meeting drop-in this Wednesday. Links to all of those events in the podcast notes. I want to leave you this week with an exclusive clip from our drop-in held Thursday, December 4th with our EM team. This was a session about the limits of the Russia and China economic partnership, but as you'll hear now, it began with Chief EM economist William Jackson talking to Senior EM economist Liam Peach about the latest in White House efforts to impose a peace settlement on Russia and Ukraine.
To just spend the first few minutes talking to Liam about the US peace plan. We've been on a roller coaster ride over the last few weeks. After this draft was released, we've seen it be amended to something more favorable to Ukraine. US representatives were in Moscow earlier this week. Can you provide us an update on the state of play and how you see the situation developing?
Yeah, I think there has been a lot of diplomacy in recent weeks, and including in November when there was that report, 28-point peace plan agreed between the US and Russia. A lot of attention has focused on that agreement and how it's seemingly seen as favorable to Russia. Large parts of it, I think, are generally seen as a non-starter, including the conditions that it places on Ukraine's territory and sovereignty. I think another detail was that Russia wants full amnesty for actions during the war, which won't happen. The outcome of the meetings between President Putin and senior US officials in Moscow this week didn't lead to anything tangible, I think, although Russian officials have described it as useful and constructive. The details were kept intentionally secret after the recent leak. So it feels like we're still no closer to a peace agreement to end the war. Putin, for example, has continued to strike a fairly aggressive tone on Russia's demands over Ukraine's territory. And fundamentally, I think Putin seems unwilling to accept any compromises. I think Putin said this week that he's willing to seize the whole of the Donbass if needed. Maybe taking a step back, I think it's become clear over the past few months that Russia will not accept peace unless it's on Russia's terms, and this is proving to be a real obstacle, I think, to achieving peace in the region. Russia feels that time is on its side and it can continue to outlast Western support for Ukraine. Putin doesn't feel that he's in any rush to accept a peace deal, even with President Trump seemingly pushing harder and harder to achieve one. There are so many parties involved that I think it's still going to be very hard to get an agreement. The EU, for example, needs to be involved around Ukraine security guarantees and sanctions really for Russia, which is what Putin is also demanding. So overall, I don't think we should dismiss the latest developments. There's certainly been a lot more in terms of talks and negotiations since the Alaska summit, but I think we still find it hard to see how there's going to be a solution, particularly given how extensive Putin's list of demands has become.
I suppose the other really important development we've seen over the course of this week is the EU struggling to put together this large financing package for Ukraine, leveraging the frozen Russian assets within Europe. Can you talk us through how important that financing is for Ukraine?
Yeah, it's been in the headlines for quite a while now. The EU struggling because of the complex legal issues surrounding the use of Russian frozen assets. Belgium, which hosts the Euroclear, where a large share of Russian assets are frozen, is concerned about any potential blowback if these assets are used. I think the original plan was to issue a loan tied in some way to eventual reparations from Russia. And I think that amounted to about 140 billion euros. And that's a significant amount. It's equal to almost all of the foreign military assistance that Ukraine has received since the start of the war. So it's a large amount. But I think even more broadly, there's a huge black hole in Ukraine's public finances that needs to be constantly filled with external support. If you just look at the size of the budget and current account deficits, next year, these are going to be more than $50 billion combined. So it's a huge amount of funding that needs to be filled. And this is key for Ukraine's macro stability, but also continuation of its war effort. The financing that Ukraine has received so far has helped to rebuild Ukraine's foreign exchange reserves considerably and help the central bank to maintain control of its currency. If some of this financing dries up or doesn't come through in the way that Ukraine's hoping, Ukraine may have to turn towards more messy solutions to help finance these shortfalls. So yeah, it really is key for Ukraine's stability.
That was William Jackson talking to Liam Peach about the potential for a peace agreement to end the Ukraine war and Ukraine's economic vulnerabilities. I will link to the full recording of that session in the podcast notes. To the extent that the Sino-Russian relationship is seen as a critical ingredient in this fracturing global economy, there are very strict limits in how that relationship is developing, despite widespread coverage about how this is an unbridled partnership. Liam's report on this issue will be in the podcast notes too, so do check that out. And remember, CE Essential and CE Advanced give you unbridled access to all of our written analysis on global fracturing, our in-person briefings, our drop-ins, our data, and much more. Get in touch at sales@capitaleconomics.com and we can get you set up today. But that's it for this week. We will be back next week to review that Fed meeting and to look ahead to what's going to drive macro and markets in 2026. Until then, goodbye.